market does seem a little complacent now with respect to what we see as brewing risks, like the trade war. Certainly that is a risk that we're spending some time on. And I think the reason the market is shrugging it off a little bit is because the US economic fundamentals are very good. So if you look at the S&P earnings, we're on pace to post 10% earnings growth this year, which is pretty good. Industrial production up 4 to 5%. Inflation's moderate, 2%, that's manageable. And companies are generally reporting very good results. And so, the fundamentals are helping the market continue to march higher with that tech leadership intact. I think about the strength in technology like this. At the later stages of an economic cycle, it's not at all uncommon to see the leadership sector continue to lead the market. For a while, you saw that in the early 1990s with consumer staples. You saw that right around 2000 with tech. In the 2005 to 2008 period, you saw that with energy. So what we're seeing in tech seems very typical in that regard. Media was a call out in the third quarter. Part of that is resolution of the uncertainty around M&A. We now know that Disney is going to buy Fox, and we know that Comcast is going to buy Sky, and we know the prices at which those assets are going to be acquired. So I think that helped media scoot a little bit higher. Industrials was also a positive call out for us, and within that sector, it's really Grainger was probably the single stock that propelled that group higher for us. Grainger's benefiting from positive industrial production and a playing out of their strategy to sharpen their pricing and use that sharper pricing to help them gain share. So that strategy is really playing out for them, and that stock has been a really strong stock all year long, actually. The healthcare sector has been under pressure for more than a year now amid concerns of drug pricing and ability of companies to effectuate drug pricing increases. Our view is that companies that have good positive clinical trial readouts and good innovative products will be able to generate decent returns. We're starting to see that with some clinical trial readouts in the third quarter that have good implications for Biogenetic and for Regeneron. So our hope is that that is going to get generalists interested in the sector again. I think trade war is probably the single most important risk that we've been spending time thinking about. And it's not just in terms of how it affects the US economy per se, but it's the ripple effects. It's how it affects the Chinese economy and what that could mean for our portfolio companies. Many of our companies, they're US-based companies, but they obviously generate 40% or so of their revenue from outside the US. And some of it comes directly from China. Some of it is indirectly impacted by China. So we've been spending a lot of time thinking about our real emerging markets exposure, direct and indirect, impacts of a strengthening US dollar and how that could affect the portfolio. Some companies are starting to talk about contingency planning in terms of moving manufacturing from one location to another to try to manage the cost of their manufacturing. In general, companies are also not seeing enormous impacts on their cost of goods sold or demand for their products. But time will tell. Sometimes that takes a little time to play out.